Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Frontline stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Frontline is the world's fourth largest oil tanker shipping company. Its primary business is transporting crude oil. The company is headquartered in Bermuda and was founded in 1985. It started trading in '98 and can be found on the New York Stock Exchange, Oslo, Mexican Bolsa, and London Stock Exchange. Its fleet consists of 68 vessels with an aggregate capacity of 12.3 million dry weight tons. It owns 61 vessels, 15 VLCCs, 27 Suezmax, and 19 Aframax. They have 2 VLCCs that are under finance leases, 1 vessel from a third party, and 4 under commercial management. The cost for a new vessel can range from $40 million to $120 million. There are only 810 VLCCs, 668 Aframax, and 571 Suezmaxes in the world. So this is a really tight-knit community with a small number of players. The VLCC stands for Very Large Crude Carrier, and it's the world's largest tanker. They're also the largest man-made mobile structures. These ships can transport 2 million barrels of oil or 318,000 metric tons. Because of how big they are, they often cannot enter port fully loaded. Sometimes these ships need to take cargo to offshore platforms. Sometimes they may need to transfer cargo onto smaller tankers. The routes for these ships are typically long, requiring them to stay at sea for extended periods of time, often 70 days at once. The supply of ships in the market is highly correlated to the profitability of these shipping companies. The cost to maintain the ships is fairly fixed, depending on the age of the ship. The revenue each ship receives can vary a lot depending on the number of ships in the market. There will always be demand by companies looking to transport oil across the ocean. To transport oil within the US or within any country, it is usually by building underground pipeline. Transporting oil between Canada and the US or between any two connected countries is also done by underground pipeline. Transporting oil from Africa to the US by plane is too expensive since you cannot fit that much oil on a plane. Shipping oil by vessels is the only viable option. After about 10 years on average, a ship gets scrapped. When the number of ships in the market falls, then the remaining ships are able to charge more per delivery. When a shipping company makes a lot of money, they usually buy more ships to keep growing. Then when the number of ships in the market gets too high again, the shipping companies are unable to demand higher prices anymore since supply of ships is greater than demand for the oil. This vicious cycle seems to happen quite often in the oil shipping industry. You almost have to figure out when the supply of ships is low and invest in tickers like NAT, EURN, STNG, DHT, TNK, INSW, or this one. On the other hand, when the supply of ships grows, then you need to sell your shipping stocks. Also, when supply of ships increases and companies lose money, some corporations are squeezed out of the market or are forced to merge like International Seaways and Diamond Shipping did recently. It does appear oil shipping stocks are getting to a really low point and an upswing seems inevitable. Trying to identify the bottom is almost impossible. Some people have been sitting on these stocks for months or years and watching them lose value. I know that can be very devastating and stressful because when a stock goes down, it seems like it will keep going down. And when a stock goes up, it seems like it will keep going up. You have to somehow separate your emotions and just focus on the long term. Frontline's 52-week low was a little over $5, so there are some people out there who have made good money with FRO. And this company's average fleet size is about 5 years, which is lower than most oil shipping companies. Older vessels are usually less fuel efficient and more costly to maintain. Cargo insurance rates also increase with the age of a vessel. As vessels age, market conditions might not justify the added expenses, so scrapping the ship may be the best option. If you scrap enough ships, you may be forced to buy or lease more vessels, which as you know are very pricey. Just something to consider when investing in a company with older ships. TK Tankers and Nordic Tankers' average fleet size is over 10 years. Another thing to consider is the price of steel. Since steel prices are at an all-time high, then scrapping old ships may make more sense because the scrap value is higher than when steel prices are low. When steel prices come down, then purchasing new ships is a smart move. You want to try to invest in companies that need to scrap old ships when the steel price is high, like now, and invest in companies that need to buy new ships when the steel price is low. The higher the steel prices are, the more likely a company will scrap its old vessels, which will decrease the ships in the market, leading to higher profits for all the oil shipping companies. If steel prices doubled, for example, I would invest a ton of money in these companies because old ships would get scrapped. This will lead to amazing margins for oil shipping companies. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $8 a share and they have 198 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had positive free cash flow in 2 years, negative in 2 years. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was negative in 2018, positive after that. Revenue is the sales for the company, and that grew a lot from 2018 to 2020, but then dipped a little in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. As you can see, their cost of revenue is pretty consistent year to year because the cost to maintain a vessel is pretty static. Since 2018, they had a similar amount of vessels in their business. So the cost of fuel, the cost of insurance, and the cost of labor, and all those things are pretty similar year to year. The big change is how much they can charge their customers. So as you can see, that varies a lot. It was as low as 740 million, and then it grew about 70% to 1.2 billion in 2020. Pretty much the same cost of revenue. That's what I was saying earlier. The number of ships in the market really dictate the prices these companies can earn from each voyage and each day. Revenue minus cost of revenue gives you your gross profit. That of course varies a lot from 90 million up to $500 million. Then below that is operating expenses, and then you have your operating income, which is positive each year, so that's good. They do have quite a bit of debt. They paid 64 million of interest on their debt, which was the lowest amount they paid in the past 4 years. And when a company pays lower interest payments, it's either because they reduced the amount of debt they had or refinance the debt at a lower interest rate. We'll see on the statement of cash flows in a little bit. They haven't really reduced their debt load, so they must have just refinanced their debt at a lower rate. So it's really nice being incorporated in Bermuda because they don't have to pay really any taxes. That's a tax shelter country. So the bottom line of the income statement is their net income, which looks pretty good. It's positive pretty much every year except 2018. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they do generate a good amount of cash flow each year, peaking in 2020 at 600 million. And their capex is pretty high because those vessels are really expensive. They spent over $700 million in 2020. Operating cash flow minus capex gives you your free cash flow. And they did have a lot of free cash flow in the trailing 12 months, the most ever at 200 million. It was also positive in 2019, but negative in 2020 due to large capex, and negative in 2018 due to low operating cash flow. So they were paying a dividend in 2018, 19, and most of 2020. So you can see in 2019 they added $98 million of capital stock. When a company issues more common stock, it dilutes the current shareholders, making your shares less valuable. But they only generated $84 million of free cash flow that year, and they paid down about $50 million of debt. So they needed to take on capital stock to fund their dividend payments. They did add a lot of debt in 2020, about $450 million. That's really to fund their capital expenditures, because they were generating positive operating cash flow from their normal business. It looks like they bought a bunch of vessels that year. Let's look at the capital structure. 1.6 billion of equity, 2.2 billion of debt. They're 57% debt, 43% equity. And their weighted average cost of capital is 12.5%. And that's the cost of equity and cost of debt. I've done 2 videos in the past on Frontline, and their WACC was a lot lower. But the more I learn about this company and this industry, I think there's a lot more risk here. So that's why I raised their weighted average cost of capital to be more in line with the risk of this industry and this stock. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.7 billion. We divide that by 198 million shares. And we get a calculated stock price of $13.44. They're trading at $8.26, so they're trading at a 39% discount. It's a strong buy according to the model. Even with a higher whack, I'm still coming out with a stock price a lot higher than they're trading at. Simply Wall Street is a lot higher than me. They're at $19 a share. They're saying the stock is 56% undervalued. 7 analysts priced this stock and the average price target was about $10. This is where the stock has been trading since 2001. So it looks like the stock peaked at $350 a share. But it was never this high. They did a 1-for-5 reverse stock split in 2016. So to figure out the stock price on the days before 2016, you would need to divide the numbers by 5. So it peaked at about $70. So around 2016, the stock price was probably getting to close to $1 a share. So they did a 1-for-5 reverse stock split. So they don't get delisted and put onto the OTC. Because when you trade OTC, there's less visibility, less people buying your stock. You want to trade on a major stock exchange like the NASDAQ or New York Stock Exchange. So you can see it's a really volatile industry. The stock came down a ton since 2008. You would have lost a ton of money if you bought it here. But if you bought it in 2001 and rode it up to 2008, you would have 10x'd your money. So it's kind of all or nothing with this stock. You make a ton of money or you lose a ton of money. You just have to time it right. This is where the stock has been trading the last 12 months. So there is a lot of promise. The stock is up about 50% from its bottom the past 12 months. The stock has really gotten crushed the past 10 years. But it could be the time when it's in for a major upswing, possibly another 10x over the next several years. The last time they paid a dividend was last September, and they were paying 50 cents a share. It was close to a 30% dividend yield. Because their stock price came down so much, it made their dividend look amazing. But I think it's good they cut their dividend. They need to conserve cash, pay down debt, and when they have a healthier balance sheet, a healthier company, then I think they'll bring back their dividend. And this stock has a pretty low beta, 0.46, so the stock isn't too volatile. It moves about half the market. It's gone up 8% in the past 52 weeks, while the S&P 500 went up 35%. The 52-week low was $5, the high was $9. The stock is trading above its 200-day, but below its 50-day moving average. And this is a pretty popular stock. I think if a stock has over 1 million shares traded on average each day, it's fairly popular, and this has about 1.4 to 1.5 million shares traded each day. Only about half the shares outstanding are on float. The shares that are not on float are held by insiders or big companies, and they can't be purchased by individuals like me and you. If the short percentage got really high for this company, and it has a low float, it will be a great candidate for a short squeeze. About 1/4 of the shares are held by institutions, and over 3% of the shares on float are shorted. In the past year, this stock has done much worse than its industry and the market. But surprisingly, in the past 3 years, this stock has done really well, much better than its industry and a little better than the market. But in the past 5 years, it has beat its industry, but it's performed much worse than the market. Analysts are bullish on this stock. They're projecting their earnings to grow 57% and their revenue to grow 15%, a lot more than its industry and the market. In the past 5 years, their annual earnings increased 28%, much better than its industry, increasing only 5%. So it seems like if you want exposure to the oil tanker industry, this would be a good stock to buy, since their financials are much better than the average company. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be down to $2,100 today. That's a 79% loss. So that would have been a terrible time to buy the stock in 2011 if you held until now. The biggest shareholder is Greenwich Holdings, which owns 40% of the stock. Frontline CEO controls Greenwich Holdings. So that is a really positive sign. The CEO of the company wants his fund to invest a lot into Frontline. He must have a lot of faith in this company's growth potential. And then a bunch of other companies own the stock, between 2.5% holdings and 5%. Let's look at their financial ratios. They have great price multiples. A 6 PE, 1.6 price to sales, and 1.0 price to book. When a company has a PE below 15, that's considered a really undervalued stock. And they're much lower than 15, they're at 6, so investors are paying $6 for $1 of earnings. And their price to book is 1.0. So their book value per share is $8.29, and their stock price is $8.26. So this implies if the company sold all its assets, used that cash to pay down all its liabilities, it would have enough cash to give each shareholder $8.29. Usually the book value per share is a lot lower than the stock price. So it's kind of like you're taking no risk when investing in this company. Of course, we don't invest in companies to shut them down and take out the cash. The company's market cap is about $1.6 billion, and according to the latest balance sheet, the vessels that they own are worth $3.3 billion. So the assets they have are worth more than the value of the company. Of course, they do have $2 billion in debt, so they do have to pay off the debt. If they had no debt, the stock price would be a lot higher. So if you invested in an IT company, there's really no assets. So during really difficult times, if the company had a hard time getting a loan, they couldn't really sell any assets. But this company has a lot of assets they can sell. That's just another thing to look at when investing in a company. If the company has a lot of assets on its balance sheet, that has value, and they could sell those assets and use the money for other things. For example, if a company with no assets couldn't pay the interest on its debt, they'd be forced into bankruptcy. But if a company has a lot of assets, they could just sell an asset to keep them in business for another 6 months or so until things got better. Their return on invested capital is only 8%. I like to see an ROIC greater than a WACC. But remember earlier when I said I gave them a higher WACC due to the higher risk. So take that into account as well. And if a company has a lot of debt, don't just say that's bad, they have a lot of debt. Look at the interest coverage ratio. If they can cover their interest payments at least 2 times, then it's okay to have debt. They can cover their interest payments 4.5 times. So the amount of debt they have is okay. It's appropriate for the amount of money they're bringing in. They have a really good ROE at 17%, much better than the market median average. And they have a good current ratio of 1.4. They have $150 million of cash on their balance sheet and $200 million of other current assets. They seem to be well capitalized. They had $200 million of free cash flow in the trailing 12 months and $100 million of working capital. So they have over $300 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 45 companies in the same industry as Frontline, and the average for those 45 companies is right here. Frontline is much better than average in almost every category. The only 2 areas they're worse than average are market cap. They have 1.6 billion market cap, the average is 9.2 billion, and they don't pay a dividend anymore. But when they did pay a dividend, it was like 30%. But I'm sure they're going to bring back their dividend next year, or possibly the year after that. So to summarize, I have them trading at a 39% discount, but like I explained earlier, there's not much magic in trying to figure out how to value these companies. It's really based on the number of vessels in the market. And the life cycle can take 10 to 15 years because vessels need to get older and get scrapped. And once enough vessels get scrapped and not replaced by newer vessels, then these companies can start making a lot of money and charging more per trip. But when there's so many vessels out there, the supply of ships is so high that everybody's trying to scramble to make money. I do think we're at a point where a lot of vessels are getting old and they're going to get scrapped, and we'll see an uptrend in these stock prices. Plus, the price of steel does play a role in this whole equation. The higher the price of steel is, and it's at its all-time high, the more bullish you should be on these stocks, because the higher price of steel means more vessels will be scrapped, since the salvage value for those ships will be higher, and less vessels will be purchased because it's too expensive to buy new ships. So there's a lot of moving parts to the equation. I hope this helps you with your investing decisions on this company and on this industry. I rank their free cash flow 6 out of 10, their revenue 6 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.